Hello, good afternoon, everyone. I'm David Silver, CEO of Instrumental Wealth, and joining me today is Chief Investment Officer Matt Harbert. I appreciate everyone hopping on our webinar today. There's a lot to get into today as far as everything that took place in the economy and markets for the first quarter of 2025. Matt, I know that today there's a lot of questions that people have submitted, and we'll certainly get into those towards the end of our presentation. But as far as our agenda today, we're going to start off with an overview of investment markets, then move into the overall economy. Obviously, lots to get into around the tariffs, and then ultimately we'll do a wrap up and some Q&A. So Matt, I'll go ahead and turn it over to you. I know our clients and our participants today have a lot of interest in hearing what's going on.
Great, thanks, Dave. So to start, I just want to note that with the recent big moves that we've had in the markets since the end of the first quarter, when possible, I have extended the data out to the end of last week. And with that being said, we'll start with the equity markets. If you notice on the chart here, we've actually had a pretty big change up in the leaders so far this year, as international equities have actually outperformed U.S. equities. So looking at this chart, you can see those top two lines, the green and pink line. The green one, which is developed equities, as of the end of last week, is actually up about 7.7%, where emerging markets are just slightly positive at about 0.36%. Over the year so far, actually U.S. equities have been correcting. You can see that in those bottom three lines, the purple, orange, and blue. And that really started with the AI sell-off, which was triggered by the DeepSeek release, but it's broadened out with the recent fears of the tariffs that are coming up. And you can see U.S. large caps are actually down about 12%. U.S. mid caps are down about 13.75%, and small caps are down just about 18%. Interestingly, though, for the international markets, in their local currencies, they've actually also been slightly negative this year. You can see that on the left chart, where both the developed and emerging markets have been negative in their local dollars versus what we saw in the chart on the previous page, which was in US dollars. So when we look at it in their own markets, the developed markets are actually down 1.7%. And emerging markets are down about 0.8%. When we look at the chart on the right, you can see that while they are still outperforming U.S. equities for the year, all equities have actually been negatively impacted through our current environment in their local markets. But what has really been the cause of this discrepancy of returns for these international markets? Well, there's been a depreciation of the US dollar so far this year. And if you look at the chart on the left, you can see that so far in 2025, the US dollar index has fallen by about 9.4%. So when we move to the chart on the right, we can compare the EFA returns in their local currency versus that in US dollars. And you can see that decline in the US dollar has actually added about 9.6% of additional return to US investors. So if we look at markets and how they compare to their highs, coming into 2025, which is the chart on the left, really markets were already off their highs. But start of the year, international equities are actually trading further off from their peaks in the U.S. markets. But we've seen a much bigger correction in the U.S. than we have internationally. And you can see that in the chart on the right, where so far this year, that has actually changed things around. So the U.S. markets are now actually trading further off their peaks than at least the developed international markets. But that really isn't much of a surprise, as U.S. markets were trading already at much higher valuations compared to international markets. This chart, you can see that historically, U.S. equities have tended to be higher valued than international markets. If you look kind of in the middle, you'll see the average there that shows 18%. And that's what that's saying is that on average, over the past 20 years, international equity PEs have traded at about an 18% discount to U.S. equities. But this spread has actually been increasing since about 2016, leading up to about a near 40% discount at the end of 2024. So with such a valuation gap, you would expect these higher valued stocks to pull back more during times of market stress. And that's actually just what happened. So while U.S. equities, you can see to the right, they do still remain rich compared to international equities. You can see that that valuation gap has narrowed by about 10%. So you can see that big narrowing of that gap to the very right of that chart. Looking at sector returns, this chart shows the returns of the Morningstar All U.S. Equity Index as of April 4th. And you can see at that time, all sectors are negative for the year. Particularly the AI heavy sectors are the ones that were hit the most. You can see those in the middle columns here with communication services that are down about 14.3%, and technology, which is down the most at down 22.07%. When we look at the column all the way to the right, those are the defensive stocks, and they've held up the best, which is what you would expect during times of market correction. You can see consumer defensive is essentially flat. Utilities are down just 1.6%, and healthcare is down 2.3%. And this brings us to the Magnificent Seven stocks. They've been a topic that we've been discussing for close to 2 years now. These are 7 companies that have been the driving force behind the exceptional outperformance of U.S. equities. We've been expecting a broadening out of that as returns on these stocks start to moderate. But the question is, how have they held up over this recent market correction? And on the left, you can see that is through December 2024. So you can see at that point, the Magnificent Seven stocks were actually outperforming the remaining 493 companies for the year by nearly 33%. However, when we move to the chart on the right, you can see in 2025, this is through the end of the quarter, so the end of March, the Magnificent Seven actually fell about 15%, while the remaining 493 companies were actually still positive 1.2%. So this does highlight the challenges of having such high concentrations that we do have in the U.S. large cap indexes, and also actually underscores the importance to diversification. And speaking of concentration, there has been actually a sharp drop in the concentration levels this year, resulting from that correction of these Magnificent Seven companies. This chart shows the percentage of the S&P 500 that is comprised of its top 10 holdings. So you look at the top 10 holdings in the S&P 500 and what percentage do they make of the index. That gives us an idea of the concentration levels. And you can see on here, if you look all the way to the right, it's actually had a big fall from about 37% to 33%. So while concentration does remain very high, this was actually a big drop in a very short period of time. So this is something we do expect to see to decline further if markets do continue on the path that we've seen. So going back to the Mag 7 companies and their valuation, This slide is actually a good illustration of how fast valuations can change during market corrections, particularly those that are at very high levels, very expensive. The Magnificent Seven companies here were hit particularly hard during this repricing. You can see all the way to the left NVIDIA. It's actually dropped nearly in half in its valuation so far this year. But across the board, all of the Mag 7 companies have seen their valuations come down pretty significantly. And then all the way to the right, you can see the overall mega cap tech category has actually come down from valuations of 31 all the way down to 21 times earnings. So it does show how these mega tech stocks were really trading at levels that were unsustainable once you hit periods of market stress like we've had now. Getting into the markets outside of equities, this actually further highlights the importance of having diversification in your portfolio. You can see all of the fixed income returns, with the exception of high yield bonds, have actually been positive this year. Global bonds have been particularly strong, given the added currency boost, and have outperformed all the other broad asset classes. And while high yield bonds were negative, they were just modestly so, basically flat for the year. On top of that, real assets have also been a very nice diversifier in the portfolio that have been up about 3% so far this year. And that leads us into the economy. And obviously, with the current tariff policy, has been making any forecasting of the economy challenging. So the policies have been very heavy, and they've abruptly changed, which has added a lot of uncertainty. With that said, we're just going to give a brief recap of what the economy has done over the first quarter, looking at inflation, the labor market, Fed policy, and GDP growth. But then we'll get into a little bit of a discussion on the current tariff policies, what they are, the quick impact that they've had, and some of the concerns of those going forward. But starting out, we'll look at inflation. Inflation has continued to be sticky and above the Fed's 2% target. Surprisingly, in March, they actually came in a little bit lower than expected. The CPI charts on the left, the headline came in about 2.4%, with the core about 2.8%. When we look at the PCE index on the right, its headline was a little bit higher than the CPI at about 2.55%, the core being about the same at roughly 2.8%. If we dig into the specifics a little bit, that top line is the overall headline CPI. And while year over year is above the target at 2.4%, it was actually slightly deflationary for the month. So in March, prices actually fell about 0.1%. And much of that can be attributed to the energy sector. If you look down that month of March column to when you hit the green areas, you can see where the big drop was in gasoline, and that actually fell prices in gasoline fell 6.3% for the month of March. On the flip side, energy services actually grew, had good increase of about 1.6%. Moving down where you'll see all items less food and energy, that column or that row is actually the core CPI number. And just to note, this is actually the number that the Fed really prefers to look at when deciding on their policy. And you can see year over year, it did come in a little lower than expected at 2.8%, but that number is still quite a bit above that 2% target that the Fed has. Month over month, though, for March, it also came in lower than expected. It was very modest growth at just 0.1%. But really the challenge here has been in the shelter segment. So shelter, if you go down, it's like the third one up from the bottom, came in a little bit lighter than it has in the past. So it increased only 0.2% in March, which is actually the lowest monthly rate that has been over the last 6 months. But year over year, you can see it's still sitting at a high 4%. So that's one thing that the Fed is keeping a heavy eye on, is that shelter and that core rate, and that's the number they really look at for their policy. Moving on to the labor market. The labor market has pretty much remained pretty resilient through the challenges so far this year, and it's remained relatively tight. Looking at on the left, both job openings and hires, they do still remain above their long-term averages, and with openings actually significantly above their average. We look to the third one down, those are quits. They've also remained above their averages. This does hint that the confidence in ability to find employment still is remaining intact as of now. Payroll additions remain solid. We've averaged just under 200,000 new jobs each month for 2025. So that's still looking pretty strong. And then the bottom right is unemployment. You see that has been rising over the past year, currently at 4.2%, but that still is under the long-term average, so nothing of concern there. So you can see that employment has remained fairly resilient so far this year. Openings to unemployed. This is basically how many jobs are available to those people that are looking for jobs. And similar to the other charts in employment, you can see it's been normalizing over the past few years, but we're currently sitting at about one job for every person that's looking for a job, and we've kind of settled in that, and it's been pretty stable there for the last few quarters. Moving on to the Fed policy. The Fed policy has really, they've moved into one on hold. So their current target range is at about 4.25 to 4.5. And their last rate change was back in December, where they did a 25 basis point cut. And the Fed right now really is in an interesting position because they're kind of facing two opposing forces right now. Projections for growth of the economy and employment is really one that's going to be slowing down with a higher chance of recession. But at the same time, with things like the new tariff policies and the immigration policies, those are additional pressures for rising prices. So the Fed's kind of caught in between that tug of war of slower growth and possible recession and lower wages on one side and higher prices on the other side. So, the expectation as of now is they will likely still lower rates this year, but it will probably be at a slower than we initially had expected, as they take sort of this wait and see approach to see kind of the impacts of tariffs and all these policies and how they work out. Probably most likely, if we do see that employment situation start to deteriorate fairly quickly, that's probably a catalyst that would drive them to maybe move back into a quicker pace of rate cutting. The markets tend to agree, at least over the next meeting. They're pricing in a 96 probability that the Fed will keep rates where they are. So we tend to agree with this, particularly with all the uncertainties that we have right now. And that moves us into GDP growth. Estimates for first quarter GDP have not been released yet, but we do have the final release of the fourth quarter. You can see that on the top row here, and that's the one all the way to the right for fourth quarter of 24. Did come in at actually a pretty strong 2.4% for the quarter. If you look one line down, you can see that was heavily driven by consumption and expenditures, as they grew at a 4% rate over that quarter. And if you look at the next the column or the rows down that are also have the color across, you'll see that 2.7%. That's how much the consumption has contributed to the overall number. So it's actually contributed the 2.7% of the 2.4%. So it's actually contributed a higher amount than the overall number ended up. And part of that is because we saw a big contraction in private investment. So private investment actually contracted by 5.6% over the fourth quarter. That's something that could end up being a headwind to future growth, especially if we continue to see this investment continue to decline. We don't, like I said, we don't have the projections or the release for the first quarter yet, but economists are kind of projecting a slower but still positive growth in the first quarter. Trying to get a sense of what this could be. You can see consumption has been the driver of growth in GDP. So getting a sense of how that was over the first quarter might give us a hint of what we could see as well. So if we look at things like retail sales growth, which is the top chart here, and total personal savings, which is the bottom chart, it'll give us maybe some idea of how strong consumption has been over that first quarter. Retail sales in March did come in at a very strong 1.43%, which is well above the 5-year average of 0.27%. However, over the quarter, the number has been, retail sales have been inconsistent. January came in at a pretty weak -1%, while February was very low at just 0.22%. Personal spending on that bottom chart has also shown some weakness, recovering a bit from a big decline back in January. The recent number came in just under the 5-year average. Just note, though, that personal consumption has lagged a little bit, so this number is only through February. We might see some recovery in March, similar to the way retail sales recovered. But overall, this does paint kind of an average picture of expenditures and is pretty consistent with economists' positive but slower growth expectations going forward. So that's kind of the recap of how the economy performed over the first quarter. As we said, there's been a lot of uncertainty, particularly with the new policy on tariffs coming in. So, kind of question is, what has happened? What has been released with the tariffs? So to kind of summarize what's going on here, President Trump, he basically invoked the IEEPA, which is the International Emergency Economic Powers Act, in order to put these tariffs on. It has been somewhat controversial and using that for tariffs, and there have been some legal challenges filed against it. But as of now, the courts have found that they're going to allow the tariffs to stay on through those legal proceedings. So getting into what he's done so far, so there was an initial 10% baseline tariffs on all imports into the United States. So that across the board, all imports get 10% tariff. In addition to that, he's put in what he calls the reciprocal tariffs, which are ranging from about 10% to 50% tariff, depending on the country. So it's country by country. There is also some controversy here as the calculations used when determining what tariffs should be placed on other countries in reciprocation, as the actual number that they have come up with showing the tariffs that other countries are placing on US imports isn't really the tariffs that they're charging. It is actually the trade deficit between our country and that country. The administration basically is saying that that accounts for things like currency manipulations and other things that aren't calculated in the actual tariff number. So there is sort of a controversy there whether those tariffs make sense. For example, over with the European Union, the actual tariffs they charge average out to somewhere around 4%, where I think the reciprocal was putting them at about 20 or 25%. So you see there's a big difference between what the administration has calculated versus what the actual average tariff rates are. That being said, there is currently a 90-day pause on these reciprocal tariffs in most countries. China is the notable exception. As of the time we put this together, the combined tariffs on China was at 145%, while China has since retaliated and increased tariffs on US goods up to 125%. There has been some talk this week about slashing that amount of tariffs charged on China, but we'll see where that goes. So what have been some of the impacts that we've seen from these tariffs, the immediate impacts? Markets initially did not respond very positively. We had a heavily negative impact. This chart shows the week that the tariffs were announced. So overall in that week, there was a big drop in all equities globally. US markets fell the most, which each of the large, mid, and small fell close to about 10% over that week. In addition, we also saw a big spike in volatility. This chart is the VIX. This is kind of a typical index that's used to measure volatility out in the market. You can see to the right, just after it was announced that the VIX had spiked all the way up to 45%. This is actually the highest it was over the past 10 years, with the exception of the pandemic back in 2020. It has since come down to about 35%. So it's come back a fair amount, but it is still actually highly elevated. You can see it's kind of sitting around the same volatility levels that we saw back when inflation was spiking and the Fed was quickly hiking interest rates. Also confidence. We did see confidence get hit a bit as well. This top chart is the University of Michigan's Consumer Sentiment Index. You can see coming into 2025, it was actually sitting up about 74, but it's plunged pretty significantly so far this year, all the way down to the last release at 50. Bottom chart is small business optimism. So we can see even in kind of those small businesses, we're seeing some impact to confidence. It's pulled back from 105 beginning of the year to 97, about 97 currently. Internationally, the dollar is sort of hinting that there's confidence is waning a bit internationally as well. You can see the depreciation of the dollar. This does kind of hint that confidence outside the US as demand for the dollar has been dropping. So so far the immediate impacts were we've seen a pretty big plunge in the equity markets, heightened volatility, confidence starting to wane a little bit. But overall, there's just been uncertainty. We talked about how that makes it a little bit more difficult to predict what's going to go on in the economy. Also makes it more challenging for businesses to predict how they're going to go forward. So, that may kind of dampen some of their investment as well as any hiring plans they may have. The other thing with that it sort of impacts is, part of the reason for these reciprocal is to get countries to come to the table and negotiate. But the challenge to that also is that, as we've seen, the actual tariffs that have been calculated on U.S. Imports isn't really the tariffs that they're charging. So it does make it challenging, even if a country wants to come to the table to negotiate. It makes it challenging for them to determine how to negotiate when the actual tariffs are not what they've calculated. So that brings us to some of the concerns going forward. We already talked a little bit about China and how they've increased their tariffs on the U.S. So obviously retaliation from other countries leading to all-out trade wars is one of the concerns. Higher inflation is another one of the concerns that we have. You've got economists at Goldman Sachs that they've actually estimated that for each 1% rise in the effective tariff rate, that the PCE the core PCE could increase by about 10 basis points. So if you figure that tariffs are up about 15% or so on average, this could add about another 1.5% rise in prices in the PCE. As mentioned earlier, for the Fed, they are stuck between potentially slower growth and higher inflation. So this uncertainty and also that rise in potential prices, one of the concerns is that they will slow down their rate cutting policy, which we think they will. Lower consumption, that's another concern. As prices start to increase, maybe employment starts to fall, and you have a downward growth in the economy. The concern is that consumption will be hit, and we'll have fewer, that will impact growth as well. And then finally, probability of recession. I mean, economists have been increasing their probabilities of recession. Out there, I've seen anywhere from increasing up to a 35% to a 60% chance this year of a recession hitting.
Well, Matt, thank you. Yeah, thank you for that. That was a lot of great data and a lot of things that I know we've all kind of heard chatter on the news and social media and whatnot over the last quarter. So it's always great to see some of these really in-depth slides and some details around. So thank you for that. As far as the key takeaways here, it really a couple of big things here that I had. First is obviously with the tariffs, there's upward pressure on pricing. We'll see the ramifications of that. Obviously, the March numbers that came out were positive for inflation. The first decline in all three measures since 2020. But of course, with the tariffs, it may be a slower path for the Fed to cut rates. Lots of uncertainty out there, both economic and market uncertainty. We all know how much markets love uncertainty and the volatility around that. And obviously, with portfolios, it's really important to remain diversified and not take on any big bets. So, super helpful information. And for all of you that were attending, thank you for submitting your questions. There's actually a few of those that we'll address here. I know we got a couple minutes left here, so we'll try to be mindful of everyone's calendar here. Um, and The first question that um, that I think we'll probably address is: do we foresee any more tariff announcements for the rest of the year? Um, I'll be happy to address this first, and then Matt, feel free to add anything to this. But I definitely think the answer is yes, as far as an announcement. Of course, what's happened since the initial tariff announcement was the administration had decided to pause on all the reciprocal tariffs and just go back down to a flat 10% across the board and work on a 90-day pause and hopefully negotiate a grand deal. As Matt had alluded to, it seems like there's some chatter between the White House and China. So we'll see what happens there. I know there's been some rumors floated out there, nothing finite, but I think we definitely expect something. Really hard to determine what ultimately will be right now. Certainly, there's a lot of speculation out there, and as those conversations continue to happen, we'll be keeping a very, very watchful ear and eye on what's going on there. So, Matt, I don't know if you have anything else to add to that.
No, I would agree. I think Donald Trump has made it, I think, pretty clear that tariffs are a tool that he really believes that can help with taking care of the deficit, as well as getting people to the table to negotiate, making things more fair, or helping, as we've seen in in Canada and Mexico, helping with other areas like immigration. So I think he really believes in tariffs as a tool. So I do think that we'll definitely see more announcements through the year.
Yeah, absolutely. So recession, the R word. Is recession more likely today than it was back at the beginning of the year? Matt, I'll let you tackle this one.
Yes. I think the answer to that is definitely yes. I think at the beginning of the year, I think everybody expected that we would see tariffs come in. But I think a lot of the economists were surprised to the degree of the tariffs that were coming in. And that kind of gets back to what we talked about as far as the actual tariffs that are charged on U.S. imports versus kind of that calculation that the Trump administration calculated. And there's a big gap. So, while we expected tariffs coming into the year, that expectation, you would look at the tariffs that were charged on the U.S. and assuming, okay, if that averaged, maybe 4 or 5% globally, and maybe the U.S. was charging 2%, 2.5%, that we'd see maybe an increase of about 2 to 2.5% in tariffs, not 15 to 20% that we've seen. So I mean, it's such a big difference. I think it caught most of the economists off guard. So I do think that's why we're seeing so many of them increasing their probabilities of a recession this year, because with that higher tariff, as we talked about, that could hit prices. It'll rise prices. That would essentially make things more expensive to consumers. So consumption could go down. That will slow growth. It also makes uncertainty for businesses to plan. So they may reduce their investments until they have a clearer picture. On top of that, they may put pauses on any hiring that they may have. So unemployment may be impacted. So all of those things could lead to slower and negative growth. So yes, I think there's definitely a higher probability of a recession now than we had before, given the much higher nature of tariffs than expected.
Yeah, absolutely. So thank you, Matt. I know we have just a few minutes left here. A lot of great questions came in. I think probably the last one that would probably be good to address is what do we see going on with international compared to U.S., Matt? Obviously, I know we've talked about this a lot in our investment committee over the last decade, really, about the U.S. just really outperforming international over the last decade. We've seen a little bit of reversion of that in the first quarter. Is that something that we expect to see here over the next 9 to 12 months with the continued outpacing of the of international markets?
Yeah, I mean, that's a difficult one to call. I mean, you've got a lot of factors that are in the mix, particularly for U.S. investors, as we showed earlier, that, if you were invested in developed markets, you would have had a return of, over 7% this year. But a lot of that was due to the depreciation in the US dollar, not necessarily the strength in the international market. When you looked at how that market did in their own markets, they were actually negative as well. So, certainly they outpaced the US in both their local and the US, but it really was the dollar that really kind of gave a boost to that investment as well. So, it's really hard to make a projection, particularly now with all the uncertainties we are talking about, are the tariffs going to remain in 90 days? Is it going to come back up to what we saw? At this point, I think, trying to make a bet whether they're going to outperform or we're going to outperform, I would say the numbers, if you look at the metrics, it would hint that they would continue to outperform. I mean, they're still on a valuation basis, still quite a bit more inexpensive than the U.S. The dollar could continue to depreciate, which would continue to add some boost to that investment. But there's so much uncertainty, I wouldn't have high confidence that would happen. I would say, one of the things that, I would say is not to take big bets one way or another, because we just don't know in this environment whether that's going to happen or not.
Yeah. Yeah, very helpful. Very helpful. And yeah, I love that slide that you went through where you compared international markets in their own currency versus U.S. currency. I think that was a really, really interesting view of looking at that. So thank you. And for all those that are attending or those that couldn't attend, I hope that you found the information today as helpful as I did. And Matt, we always appreciate you sharing your nuggets of wisdom with us and our clients. So if you have any questions after watching this, feel free to reach out to your advisor. Feel free to message us back via email. We'll be happy to schedule a call to talk through any questions that you might have around what's going on here in the webinar or any other questions that you might have. So thanks everyone for joining us, and have a great weekend.